Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jonathan Molchan, co-CEO of STF Management, to discuss the challenges associated with asset allocation. Jonathan, it's great to have you with us. Welcome to TradeTalks.
Thanks, Jill. It's great to be here.
You got it. When you talk about the challenges associated with asset allocation, what exactly are you referring to here?
Sure, Jill. So, two of the biggest challenges investors historically, currently, and going forward face is how to remain fully invested in the appropriate asset allocation program. And this is regardless of various market cycles, and perhaps equally as important, how to also generate income that lasts through retirement. So, over the past few years, there's been no shortage of headlines, articles, commentary on whether 60/40 has run its course and if it's a viable investment approach going forward. Much of this has been debated since in 2022, investors following a 60/40 lost more being invested in bonds than they did in stocks. So clearly a phenomenon where after multiple decades of declining interest rates, we saw a sharp and violent reversal where interest rate volatility exceeded that of most equity benchmarks. And what ultimately happened here was investors were scrambling for a solution since what was considered once risk off left them taking on more risk while attempting to generate that consistent stream of income. You know, the other side of the equation, Jill, is the risk asset stocks. US equities have long been considered the cleanest shirt in the hamper since the recovery of the '08 financial crisis. And the multitude of concerns and catalysts to the downside may have changed over the years, but they've always been present, even today, right? And many investors who capitulated in '08 realized severe losses and questioned if the market had recovered too quickly. They do that again today. And if it truly was an appropriate time to get reinvested. This moment of human emotion and attempting to time the market is not necessarily a challenge, but more of an insurmountable task when your retirement's at stake. However, if you look back 10 years, the Nasdaq 100 was around 3,000, and today it's just around 13,000. So these challenges obviously don't go away. It's more in how they are addressed to minimize the capitulation, standing on the sideline and falling behind in your overall investment objective due to the correlation between human emotion and changing market conditions. So, you know, at STF, our goal is to avoid the outsized moves, both up and down, while remaining fully invested.
So, Jonathan, you want to avoid outsized moves. You want to even up the up days. You want to even up the down days while remaining fully invested. How do investors accomplish that?
Sure. So we have an approach that we call TUG. That stands for Tactical Unconstrained Growth. What we watch for is changes in market price action, volatility, and the rates of change over various timeframes. That all sounds great, but perhaps the most important part is we look at the relationship between two uncorrelated assets. And for a long time, that was stocks and bonds. And clearly that relationship became more correlated last year, making solving for asset allocation that much more difficult. So the big question is, how can you preserve capital in that type of an environment, knowing that sell-offs and these anomalistic correlations don't last forever? So if an investor were to passively remain fully invested, the conversation shifts to what does the recovery period look like in the event that a buy and hold strategy is exposed to a severe market downturn. So memories of .com, GFC, COVID become a big talking point when investors try and seek out a solution to avoid that inevitable downturn and possess the ability to compound a larger principal balance as the market inevitably recovers. So if a risk-on strategy stocks were to avoid the 20 worst days since 2007 in the NASDAQ, the return is roughly 4 times that of a passive investment. If we look at avoiding the 20 best stock days in the NASDAQ, it's roughly a quarter of the return of a passive investment. So these outsized moves tend to happen quite closely together, which only stoke uncertainty. So an approach like TUG can remove many of the outsized days, still perform, but with less volatility. And it's the volatility that drives the investors to capitulate. So at the end of the day, TUG's tactical management helps the advisor and the client maintain clear investment posture without all of the emotional responses of fear and greed.
Right, and of course it's an interesting concept, certainly not new by any means, but how do investors access the investment approach?
Sure. So I'll start with this. And ETFs have primarily been used to grant an investor exposure. Our ETFs at STF are designed to enhance investment experience and the ultimate outcome. We grant similar core exposure with less volatility without sacrificing long-term capital appreciation. Our ETFs are TUG and TUGN, both are Nasdaq listed, and we believe our modern approach to asset allocation is the same in both, but that the catch is that TUGN pays a monthly dividend supported by an active option overlay strategy. So the TUG ETFs offer a risk managed asset allocation to investors seeking to avoid human discretion and emotional bias associated with managing a traditional balanced portfolio. The ETFs can be allocated across the Nasdaq 100 index and bonds. The fixed income allocation pivots between long duration T bonds or short duration T bills, and this is all based on interest rates, inflation, and equity market correlation. The underlying holdings in TUG-N also do not affect the collateralization of the options. So to sum it up, the TUG ETF seeks to provide similar exposure to both stocks and bonds held in a traditional 60-40. TUG has historically exhibited less volatility than a passive allocation consisting of 70% Nasdaq 100 and 30% US government bonds. And TUG-N employs a call spread using NDX index options that pays up to 1% in monthly yield. So generating consistent income, managing market volatility in any portfolio is typically a priority to most investors. And that's why we're excited that we are approaching our 1-year anniversary on our 2 active ETFs.
All right, Jonathan, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.